so originally when we set this up, I wanted to come in and talk about how fantastic January was, because January was an absolutely outstanding month. And then in between the time when we set it up and today, markets have become a bit more wobbly. So what I'm going to do is talk about what happened in January in Asia, what happened in the last few days in Asia, and then talk about what I expect to happen in the rest of 2018. Okay, so to start, in January, Asian markets were absolutely on fire. A lot of Australians were on holiday and were maybe not paying that close attention. But within January, the Hang Seng China Enterprise Index, which is Chinese shares that trade in Hong Kong, it was up almost 16%. So this was an absolutely massive move. Overall, Asian markets were up, around 5%. And what was driving this? The first one is just strong fundamentals. We're going through a synchronized global recovery, and emerging markets, particularly in Asia, are a major beneficiary of this. Secondly, is seasonality. If you remember, in the end of 2017, there was quite a bit of profit taking. And so, when portfolio managers came into work on January 2nd, there was a lot of cash sitting there, and it needed to be deployed. A lot of that went into emerging markets and into Asia. Thirdly, in terms of the USD was very weak during January, and that is typically very positive for Asian markets. There was a lot of emerging market inflows. 2 weeks in January had record inflows. And then lastly, particularly with Hong Kong, I want to highlight the power of the southbound flows. So what southbound means is there's this stock connect that has been set up, which means it's much easier for Chinese mainland investors, both institutional and retail, to invest in the Hong Kong market. So it's called the southbound flows, and these have been absolutely off the charts year to date in 2018. Yesterday, there was 6 billion of southbound flow, which is, compared to when the Stock Connect started, that's a massive improvement. And we've noticed that this southbound flows can make really significant differences at a stock-specific level. So that's one thing that has been driving the Chinese banks in particular. So then by mid-January, though, we started to notice that a lot of markets in Asia, a lot of markets globally, and a lot of the stocks in our portfolio were getting overbought. So we don't talk about technical analysis that much because we are fundamental investors and our process is first and foremost fundamental. But we do have a whole technical overlay, infrastructure at EAI that we run on a weekly basis just to see how things are trading on a technical basis. So we have a Monday morning meeting, and usually we run RSI, so that's a relative strength index. Are things overbought or oversold? In a typical week, we'd have maybe 10, 15 stocks that are overbought, 10, 15 that are oversold. By mid-January, we were getting 250 stocks that were overbought. And then, so we do it on a market level. Almost every single market in Asia, except for ASEAN, was overbought. S&P was overbought. Oil was overbought. USD was overbought. Iron ore was overbought. And so this was sending us a very, very strong message that this is time to start taking profits. So in mid-January, I did start taking profits just on a sort of piecemeal basis. Stocks which had gotten really close to their price target in a very short period of time, or stocks that had RSIs in the 90s, which is almost unheard of. So I took profits in 10 different stocks. We only have 48 in the portfolio, so that's quite a bit. And cash went from approximately 5% at the end of 2017 to just over 10% now. So it took a lot of profits, and that has ended up being a good thing to do because, as I'm sure you all know, February has been quite volatile. So it's been a sharp market correction, and we think it's definitely overdue, and it's a healthy correction. Nothing really has changed fundamentally. So I was saying to Lisa beforehand, in the last 4 days, I've made no trades in Asia. We're just kind of watching what happens, and we're running those same sort of technical indicators to see what's getting oversold in this current sell-off. Okay, so I'll move forward just to talk a little bit about what's happened to EAI. This is another reason why I really wanted to come in and talk to you today. So EAI had a great January. We were up 5%. The NTA increased by 5%. And remember that the Aussie dollar appreciated quite a bit in January. So in local terms, we were up more like 7 or 8%. So it was a very strong January. This was driven by Chinese markets primarily, and particularly by Chinese financials. So I want to make this point because when we did our roadshow last year, and I said, I haven't owned Chinese banks in 12 years. I've hated them for a really long time. And I've invested in the sector. I got a lot of pushback. People saying, oh, they're debt-ridden, they make up the numbers, they're terrible, they're uninvestable. And this sector, the Chinese banks index was up 22% in January. Some of the banks like China Construction Bank, ICBC, that I own and continue to own, they were up almost 25%. So there's been a huge change in Chinese banks. Part of this is fundamental, They've done a significant cleanup of the NPL situation in China, sorry. And secondly, the valuations prior to this run-up were just ridiculous. You had banks that were trading at a 5 times PE with a 5% dividend yield, and were trading at 0.7 times book. So even now after the rally, they're still trading around or slightly below book value. So this is a sector where we have taken some profits, but what I continue to like. Hong Kong Exchange is another Chinese financial which contributed a lot of absolute and relative return in January. So what I was talking about before with the southbound, Hong Kong Exchange is sort of an agnostic play on that. I don't care what stocks people buy. I don't care whether it's southbound coming to Hong Kong or northbound going to the Shanghai markets. All that money has to go through Hong Kong Exchange. So volumes have been very, very high. It was about $33 billion traded in Hong Kong yesterday. And Hong Kong Exchange is obviously the biggest beneficiary of this. The other point that I'll make is that while we were taking profits, I am very, very disciplined about taking profits this year, because we've heard feedback from yourselves and other investors that a dividend is important to EAI shareholders, and we want to be able to pay a dividend. Last year, we did have strong returns, but we didn't have very many realized gains. And obviously, you need to realize the gains and pay tax to get the franking credits. So the fact that I realized a lot of gains in January, and we're paying a tax on that, bodes well for our ability to pay a fully franked dividend this fiscal year. But then lastly, if you can just look at the chart, I was getting really frustrated in January because markets were going up and our NTA was going up and the stock price was doing absolutely nothing. So, and even yesterday, there's obvious concern about markets generally, and the stock price fell to 107. And the NTA is, it's not been damaged that much in February. So the discount has widened a lot. So we're going to be out talking to investors, doing everything that we can to close that discount and make sure that the stock price is reflective of what's happened to the overall fund thus far in 2018. And then lastly, I'll just give an outlook in terms of what we expect to happen in Asia for 2018. For those of you with a very good memory, you've probably seen this slide before. These are kind of the main things that are driving Asia, and I just changed the words on the side as we go through the year. So in China, the power of southbound, I've mentioned before, this is something that you have to keep your eye on. And the other main market event in China in 2018 is MSCI A-share inclusion in MSCI in May. And we've heard a lot of anecdotal evidence that big global funds are hiring Chinese-speaking A-share analysts like crazy. It actually coincides with MiFID, where a lot of these analysts are looking for jobs anyway. But there's a big ramp up going on in Hong Kong in order for the big global funds to be able to invest. We've been investing in A-shares I've been investing in them for 15 years. This fund has invested since inception. And so we feel like we're already way ahead of the game in terms of that analysis. Right now we have about 4% in A-shares, but I want to get that to around 10% prior to the inclusion. In India, the Indian market has underperformed a little bit in 2018 versus China. The budget came out on February 1st, and there was some concern going into that they were going to change the tax regime in India, which they actually did. They put a 10% long-term capital gains tax on equities, which is obviously bad for equity investors. And it was bad timing because it corresponded right when the U.S. started selling off. So India's gotten whacked a bit in the last few days. But the long-term structural story is definitely still there. The third quarter earnings were very encouraging. The last thing I'll say about India is we are watching the oil price. India is a beneficiary of a low oil price. When it starts to get up to 70, that makes me a little bit nervous about India, and I would probably trim India holdings if it went above 70. And then North Korea. North Korea is something I've got a lot of questions about from Morgan, so I'll spend just 2 minutes on that. It's really calmed down. There's been some progress made in terms of North and South have used, there's a hotline between the two countries where they can talk. They've had a meeting. There's a lot of goodwill around the Olympics and North Korea being able to send athletes to the Winter Olympics in South Korea. So the question is this Olympics-related blip and a seasonality thing? They usually don't do missile launches in January and February anyways because the weather is bad. So is this just a seasonal thing, or is this the new normal? My personal view is this is just a seasonal and Olympics-related thing, and the North Korea risk could ramp up later in the year. But we'll enjoy it while it's here. And then fourthly, in terms of iPhone, one sort of disappointment is that iPhone X sell-through has been very disappointing. I'm sure you've even heard in the news. Ask your friends how many of you have bought an iPhone X. Probably no one. The price point seems to have been made way too high. So that's not selling through very well, and that has implications for our supply chain names. We have trimmed some of them as the bad news about iPhone X started to leak through, but that's a sector or a subsector that I would expect to stay under pressure probably until April. And then lastly, in the US, there's obviously a lot going on in the US. The one thing that I really have my eye on for the rest of 2018 is the risk of a rising trade war. So you may have noticed earlier in January, the US put increased tariffs on washing machines and solar, which that's not a big deal. It doesn't impact any of our companies or really China macro at all, but it is a signal that they are going to be more aggressive on trade. The next negotiation to come up is on steel, and that is obviously more important than washing machines, but it's still not a massive impact on China. Only about 5% of Chinese steel exports go to the US, and that could easily be redirected elsewhere or consumed domestically. The real biggie on trade is intellectual property. And if you ever, can't sleep one night, there's a 161-page report on the U.S. Treasury website where they document all of China's ways that they have not met WTO standards since they got in, and IP is a really big one. So IP is important because, there's a lot of tech in Asia, and it's unclear how it would come out, because if they really do go after Asia in terms of intellectual property, they'd be shooting a lot of American companies in the foot because that's their supply chain. So it's unclear how that's going to come out, but there is definitely rising risks of a trade war, and we're watching the NAFTA renegotiations very closely. And then lastly, just to see what happens with the USD. I've said this before, my preference is for a very weak Aussie dollar. That's typically much better for our portfolio. But at this point, even just a stable USD would be welcome. You don't want a very strong USD, or a lot of those emerging market inflows that have come in January might start to reverse. But stability or a slightly strengthening USD would be welcome. And so I'll just quickly wrap up, and then we can go to Q&A. Yeah, so I guess the most important thing is January has been a great month. February has been quite volatile, but we're still doing very well. And as of last night, it looks like markets may be heading back up again. There's no need to panic. This was just a sell-off that sort of needed to happen, and we took profits going into it. The outlook for Asia in 2018 is very strong, and yeah, our positioning remains the same. That's why I don't have any slides, any pie charts. We have big positions in China and India and tech and financials. And then lastly, we're very committed to managing the discount and to making sure that our stock price reflects what's actually going on in the fund.